Chapter 6. Financial IQ number 4, Leveraging Your Money. On August 9, 2007, the stock market plunged nearly 400 points. The Federal Reserve and central banks around the world began injecting billions in cash into the economy to make sure the panic did not spread. The market was still nervous the next day. As I was getting ready for the day, a newscaster on a morning television program was interviewing 3 financial planners and getting their opinions. Their unanimous advice was, don't panic, stay the course. When asked for further advice, all 3 said, save money, get out of debt, and invest for the long term in a well-diversified portfolio of mutual funds. As I finished shaving, I wondered if these financial experts had all gone to the same school for parrots. Finally, one advisor took a moment to say something different. She began by condemning the real estate market for causing the mess in the stock market, blaming greedy investors, unscrupulous real estate agents, and predatory mortgage lenders for causing the subprime mortgage mess, which led to the crash in the stock market. This advisor said, I told my clients that real estate was risky, and my advice has not changed. Real estate is a risky investment, and investors should invest for the long term in blue-chip stocks and mutual funds. As the financial planner on television was ending her attack on real estate, my wife Kim walked into the room and said, Remember, we have a closing today on the 300-unit apartment house. Nodding my head, I said, I'll be there. As I finished dressing, I thought, it's funny the financial advisor's saying that investing in real estate is risky. The real estate markets are crashing at the same time Kim and I are buying a $17 million apartment house in Tulsa, Oklahoma, and we are excited about it. Are we on the same planet? So what is the difference between the financial planner who was negative on real estate and why was I excited about buying more property? The answers to that question are found in this chapter through 2 financial concepts, control and leverage. The new capitalism puts millions of workers' money into investments that allow them very little control or leverage. Because I have control over my investments, I am not as affected by market crashes. Because I have control, I am confident about using a lot more leverage. So what is leverage? In very simple terms, the definition of leverage is doing more with less. A person who puts money in the bank, for example, has no leverage. It's the person's money. $1 in savings has a leverage factor of 1 to 1. The saver puts up all the money. For my investment in the 300-unit apartment house, my banker put up 80% of the $17 million real estate investment. By using my banker's money, my leverage is 1 to 4. For every $1 I invest in the deal, the bank lends me $4. So why did the financial planner on TV say that real estate was such a risky investment? Once again, the answer is control. If an investor lacks the financial intelligence to control the investment, the use of leverage is very risky. Since most financial planners put people into investments where they have no control, they should not use leverage. Using leverage to invest in something you do not control would be like buying a car without a steering wheel and then stomping on the gas pedal. Most of the people being hurt by the real estate meltdown are people who were counting on the real estate market to keep going up and increasing their home's value. Many people borrowed money against their inflated home value. Now their home may be worth less than what they owe. They have no control over the investment and are at the mercy of the market. The value of my $17 million apartment house is not based upon the price of the building. While price is important, I'm not counting on the price of the building going up due to some magical, unseen market condition. That is why the booms and busts of the markets do not concern me that much. The value of my apartment house is based upon the rent my tenants pay. In other words, the true value of the property is the value my tenants think the property is worth. If a renter thinks the apartment is a good value at $500 a month, that is the property's value. If I can increase the perceived value of my property to my tenants, I, not the market, have increased the value of the property. If I increase rents without an increase in perceived value, the tenant moves to the community down the street. The value of rental real estate, in this case my apartment houses, is dependent on jobs, salaries, demographics, local industry, and supply and demand of affordable housing. In a housing crash, the demand for rental units often goes up, which means demand and rents go up. If rents go up, the value of my rental real estate may go up, even if the value of residential real estate is coming down. There are 3 specific reasons why I'm not concerned about market crashes when it comes to the purchase of my 300-unit apartment house. One reason is because Tulsa, Oklahoma is an oil boomtown. High-paying jobs are plentiful. The oil industry needs workers, and transient workers need rental housing. The second reason is because a local college near the apartment house is doubling its number of students, but not the number of on-campus housing units, which increases demand for rental apartments. As many of you know, there is another baby boom, commonly referred to as the Echo Boomers, a generation just now entering college, which is 73 million strong. A majority of them will be renters. The third reason is because the fixed interest rate on the existing loan is very low. Low interest payments, lower expenses, and increasing income will increase property value, not market fluctuations. This means the 300-unit apartment house offers me both control and leverage. My job as an investor on this apartment house is to increase my leverage from 1 to 4 to possibly 1 to 10. That is, doubling the value of the property through operations, not the market. I can do this as long as I have control. Leverage is not risky. Many financial advisors will tell you that higher returns mean higher risk. In other words, leverage is risky. That is absolutely false. Leverage is only risky when people invest in assets that they have no control over. If a person has control, leverage can be applied with very little risk. The reason most financial advisors say that higher returns means higher risk is simply because they sell only investments that allow very little control. As mentioned above, my $17 million apartment house in Tulsa is a good investment to use leverage with because I have control over the operations, and the operations, that is, income collected through rents, determine the value of the investment. A house is not a good investment, and leverage is risky with a house because you do not control the value of the house. The value of a house is based on the market and the purchasing power of the currency it was purchased with. These things are out of your control. What is control? The major flaw in paper assets, such as savings, stocks, bonds, mutual funds, and index funds, is the lack of control. And because you have no control, it is difficult and risky to apply leverage. Because these paper assets offer very little control, it is difficult to get a bank to lend you any money to invest in these assets. Financial intelligence is the key to control. Financial intelligence is the key to control. Financial intelligence increases control, and financial IQ measures the financial returns of financial intelligence. Take the 300-unit Tulsa apartment house as an example. Number 1, the income column. The first step after acquiring the property is to increase the rent. The property is already profitable and cash flows with existing rents. In other words, I am already making money from day one. Even so, the objective or business plan is to raise the rent per unit to an additional $100 a month over the next 3 years by the following means. Raising the existing rents that are under market. Installing washers and dryers in all the units and charging extra for rent. Completing improvements to the property like landscaping and new paint. All of these can be completed by using the bank's money, not mine. When we provided the bank our business plan, these improvements were part of it and were factored into the total loan amount. Multiplying 300 units by $100 over 3 years, this increases the entire project's monthly income by $30,000 a month, or an additional $360,000 a year. This increase in income is an example of control and leverage. If the plan works, 3 years from now my financial IQ number 4, leverage, will be infinite because the increase in income will be achieved by no additional capital from investors, just good knowledge of how to manage the asset, control, to higher and higher profitability. The increase in financial IQ is infinite because the increase in income will be achieved by using investor control and the bank's money. Number 2. The expense column. The next controllable objective is to lower expenses. This is done in different ways. One specific example is by reducing labor costs through reduced administrative costs. Since we own other properties, many costs can be brought back to the main company. These are sometimes called back office expenses. They are the cost of accountants, bookkeepers, attorneys, and administrative staff. Other expenses that can come down are insurance, property taxes, water consumption, maintenance, and landscaping through better cost management and economy of scale. Also, expenses can be reduced and income can go up by keeping turnover low, the time it takes to re-rent an apartment. For example, the moment a tenant informs the management company that he or she is leaving, an ad is run advertising the apartment's availability. Once vacated, the cleaning crew comes in that day and the apartment is ready to show to a potential new tenant that night. And in many cases, an apartment is rented before the existing tenant even moves out. Obviously, many incompetent investors fail to reduce expenses and actually increase them, making the property a bad investment. Often they fail to manage the quality of tenants and the attractiveness of the property because they are trying to save money. In most cases, the property goes down in value. It's these poorly run properties that we like to buy because we can turn them into good investments through good property management. In other words, we make good money from bad investors. Property management is a key control. As you know, property management is one of the keys to profitability of real estate. Property management is a key control. Like most investors, I hate property management. That is why I have Ken McElroy, author of the ABCs of Real Estate Investing, as a partner. His company is absolutely the best. If you would like more information on property management or how to increase the value of real estate through property management, the Rich Dad Company offers several books and audio products created by my friend and investment partner Ken, whose company is a leading property management company in the southwestern United States. One of the reasons why I stay clear of most stocks and mutual funds is because I have no control over expenses, especially management salaries, bonuses, and fees. It makes me sick to read about a greedy CEO's increase in pay even as shareholder value drops. Number 3. The liability column. My 300-unit apartment house had an existing mortgage interest rate of just 4.95%. The low interest rate increases the asset value of the entire property. By adding a second mortgage at 6.5%, we created a blended rate of about 5.5%. 4.9% plus 6.5% equals 5.5%. This low interest rate is an important control and leverage. A percentage point on millions of dollars has a great impact on net income. For example, a 1% savings on a $10 million mortgage is $100,000 in extra income annually. Number 4. The asset column. By increasing rents, reducing expenses, and reducing debt, or interest on debt, the asset value of the property increases. Before going on into higher forms of leverage and control, I believe it is important to recap and review the points covered so far before getting more complex. These are the 7 points. Point number 1. There are many types of leverage. The financial leverage most people are familiar with is the leverage of debt, that is OPM, or other people's money. All 5 financial intelligences, which are increasing income, protection from predators, budgeting, leverage, and information, are forms of leverage. Leverage is anything that makes your job a little easier. It's easier to move a heavy object with a forklift, and it's easier to make a sophisticated investment decision with a higher financial IQ. Point number 2. Most investors invest in paper assets they have very little control over. Examples of paper assets are savings, stocks, bonds, and mutual funds and index funds. Because these assets allow little to no control, these investors have very little leverage and low returns on investment and reflect a low financial IQ. An example of low financial IQ is a 5% return on savings, paying taxes on that return, and then having inflation almost wipe out its value. Point number 3. An increase in returns does not mean an increase in risk. When financial advisors say that an increase in returns means an increase in risk, they are right when speaking about paper assets. They are wrong when speaking for all assets. Assets, such as a business or real estate, require more financial intelligence, allow for more financial control, and permit a higher degree of leverage with very low risk. The key to low risk is higher financial intelligence. This is why I recommend that people start small and stay small as they allow their financial intelligence to increase. With an increase in financial intelligence, their returns on their investments increase. Point number 4. Most financial advisors are not investors. Financial advisors are simply salespeople. Most financial advisors, even many real estate brokers, invest only in paper assets if they invest at all. Most have very little leverage professionally and financially. In many cases, their professional and financial leverage ratios are 1-to-1. A 1-to-1 professional ratio means they get paid for their work and only their work. A day's pay for a day's work. As a business owner, I have thousands of people working to assist me. As an investor, like in the example of the Tulsa apartment house, I have 300 tenants helping me pay for my investment, the bank lending me $4 for every one of my dollars, and the tax department giving me tax breaks on my income. These are examples of different types of leverage. Point number 5. Financial education increases financial intelligence. Most people invest in paper assets, such as savings, stocks, bonds, and mutual and index funds, because they do not need or want control. All they want is to turn their money over to an investment advisor who hopefully does a good job, out of sight, out of mind. If people want more control, the first thing they need to control is their financial education, which increases their financial intelligence and hopefully increases their financial controls and leverage ratios. Point number 6. Leverage can work in 2 ways. Leverage can make you rich, and leverage can make you poor. This is why leverage requires financial intelligence and financial controls. With stocks, a trader can use the leverage of options. If a trader thinks the market is going up, they may use a call option, which is the right to purchase a stock at a certain price within a certain time. If the trader thinks the market is going down, they may use a put option or short the stock. In other words, a trader has the potential to make money if the stock price is going up or going down. The problem, however, is that the trader has no control over the asset, just control over the terms of their trade. Learning to trade a market, even in real estate, is an important part of an investor's financial education. Real estate investors also use options. In real estate, a call option is known as a down payment. Since most of my investment in real estate is based upon rental prices and operating costs of a property, up and down markets in real estate do not affect me as much. While I do occasionally flip a property, especially if someone is willing to pay me a ridiculous price for it, as a practice, I would rather buy a property and collect rent and other income for a long time. Then I look for another property to buy and hold. Point number 7. When most financial advisors recommend diversification, they are not really diversifying. There are 2 reasons why the diversification they recommend is not diversification. The first reason is that financial advisors invest in only one category of asset, paper assets. As the market crash of August 9 and 10, 2007 revealed, diversification did not protect paper asset values. The second reason is that a mutual fund is already a diversified investment. It is a hodgepodge of good and bad stocks. Professional investors don't diversify. As Warren Buffett says, diversification is a protection against ignorance. Diversification is not required if a person knows what they are doing. Instead of diversifying, professional investors do two things. One is to focus only on great investments. This saves money and increases returns. The second is to hedge. Hedging is another term for insurance. For example, my 300-unit apartment house is required by the bank to have all sorts of insurance. If the property burns down, insurance pays my mortgage and rebuilds the building. Best of all, the cost of the insurance is paid out of the rental income itself. Two of the main reasons I do not like mutual funds is that banks do not lend money on them, and insurance companies will not sell me insurance against catastrophic loss if the market crashes. And all markets crash. On to more leverage, higher returns, and lower risk. Focus, not diversification, is the key to more sophisticated leverage, higher returns, and lower risk. Focus requires more financial intelligence. Financial intelligence begins with knowing what you are investing for. In the world of money, there are two things investors invest for: capital gains and cash flow. Number 1. Capital gains. Another reason so many people think investing is risky is because they invest for capital gains. When a person says, "I'm buying this stock, mutual fund, or piece of real estate," he or she is investing for capital gains, an increase in the price of the asset. For example, if I had purchased the $17 million apartment house hoping I could sell it for $25 million, then I would be investing for capital gains. Number 2. Cash flow. Investing for cash flow is a lot less risky. Investing for cash flow is investing for income. If I put savings in the bank and receive 5% in interest, I am investing for cash flow. While interest is low risk, the problem with savings is the return is low, taxes can be high, and the dollar keeps losing value. When I purchased the 300-unit apartment house, I was investing for cash flow. The difference is, I was investing for cash flow using my banker's money for a higher return on investment and paying less in taxes. That is a better use of leverage. What are you investing for? Most financial advisors recommend that a person invest in growth funds when he or she is young. Investing for growth is investing for capital gains. They advise older investors to then shift their growth funds into income funds or annuities. In other words, invest for cash flow when you are older. They believe cash flow is less risky and more certain. When it comes to capital gains or cash flow, there are three general types of investors. They are: Number 1. Those who invest only for capital gains. In the world of stocks, these people are called traders, and in the real estate market they are called flippers. Their investment objectives are generally to buy low and sell high. When you look at the cash flow quadrant, traders and flippers are actually in the self-employed quadrant, not the investor quadrant. They are considered professional traders, not investors. On top of that, in America, traders and flippers are taxed at the higher self-employed quadrant tax rates and do not enjoy the benefits of the tax breaks the investor quadrant receives. Number 2. Those who invest only for cash flow. Many investors like savings or bonds because of the steady income. Some investors love municipal bonds because they pay a tax-free return. For example, if an investor buys a tax-free municipal bond paying 7% interest, the effective return on investment, ROI, is the same as receiving a 9% taxable return. Number 3. The investor who invests for capital gains as well as cash flow. Years ago, old-time stock investors invested for both capital gains and cash flow. Old-timers still talk about the price of a stock going up, as well as paying the investor a dividend. But that was in the old economy, the old capitalism. In the new capitalism, most paper investors are looking for the quick buck to make a killing. Today, the big investment houses are hiring the smartest whiz kids out of college and using computer models to look for the slightest market patterns they can exploit. For example, if the computer picks up a 1% differential, let's say in tech stocks, the investment house will bet millions of dollars hoping to gain 1% on millions of dollars in a few hours. This is very high leverage and very risky. These computer models also cause a lot of the volatility in the markets. When the stock market announces that program trading has been halted, it is talking about these computer programs being halted. The markets crash if the computers say sell. If the computers say buy, the markets boom, and then they crash. In other words, prices can go up or down for no fundamental or business reasons at all. A stock price may have no relationship to the value of the company because the computers created an artificial supply or demand. As an old-time investor in this new era of capitalism, I must be smart enough to invest for capital gains, cash flow, leverage of debt, and tax advantages, as well as be above the turmoil the whiz-kids and computers cause in the marketplace. There are 3 components to being a good real estate investor. They are, number 1, good partners. As Donald Trump says, you cannot do a good deal with bad partners. This does not mean bad partners are bad people. They may just be bad or wrong partners for you. For this 300-unit apartment house project to work, I must be sure I have good partners. Number 2, good financing. Real estate is primarily a function of financing. Many people say, location, location, location. I say, financing, financing, financing. If you can secure good financing, the deal works. If you have bad financing, the deal will not. To illustrate my point, let's say the seller says, I want $35 million for my $17 million apartment complex. If the seller lets me finance the $35 million purchase price at $1 a month for 30 years with a balloon payment of $35 million at the end of the term, I would take the deal and give the seller the asking price. At $1 a month for 30 years, I can afford to pay $35 million for a $17 million property. As they say in the world of finance, I'll give you your price if you will give me my terms. Number 3, good management. One of the reasons for my confidence in the $17 million 300-unit property is that I have good partners. Ken owns a property management company, and his partner Ross owns a real estate development company. In the following paragraphs, I will further explain how property management and development are essential to increasing rents, lowering expenses, and increasing asset value. Having control over these 3 components, good partners, good financing, and good management, I am more willing to use debt as leverage. Without control, I would probably not use debt financing. If there is higher risk, such as speculating in a stock or a commodity, I like to use higher returns with less risk. I'm going to further explain my confidence in the investment thanks to my partners and having control over the 300-unit apartment project, why I am willing to use a lot of leverage, why I believe the risk is low, how I make more money, and how I pay less in taxes. There are 3 more advanced investment strategies that require a higher level of financial intelligence. The 3 advanced leverage strategies are OPM, ROI, and IRR. Number 1, OPM, other people's money. There are many ways to use OPM. With the 300-unit apartment building, I am using 80% leverage. First of all, the beauty of using the bank's money is that it is tax-free money. The other benefits of the bank's money are I keep the appreciation, cash flow income, tax benefits, and amortization. The bank puts up 80% of the money, but I receive 100% of the benefits. What a great partner! Number 2, ROI, return on investment. A confusing concept for many investors is the return on their money, or ROI. For example, when you read financial publications, many mutual funds claim they have gone up by 10%. But my question is, did any of that 10% return to the investor? And how did they measure that 10%? Some funds measure the 10% by the price of the shares in the fund going up. For example, if a year ago the price per share in the fund was $10 and today it's $11, they can claim a 10% return. In this case, the return was measured in capital gains. As an investor who invests for both capital gains and cash flow, the only return I count is the cash flow. For example, if I invest $10 and each year after taxes I put $1 in my pocket from cash flow, my return is 10%. I do not count the return on asset appreciation because it is an estimate and does not become a reality unless I sell the asset. The difference is that one measure of the ROI is in the price of the stock, and the other measure of ROI is money in my pocket. I actually want both, 10% in asset appreciation and 10% cash in my pocket. But cash flow is the only return that can be tangibly measured while I hold the asset. More leverage, higher returns. The reason leverage is so important is because the higher the leverage, the higher the return. For example, if I buy a $100,000 rental unit with my money and I receive $10,000 a year net income, my cash-on-cash return is 10%. If I borrow $50,000 and am still able to receive a $10,000 return, my cash-on-cash return is 20%. If I finance the entire $100,000 and still receive a $10,000 return, my return is infinite. Infinite returns mean money for nothing. $10,000 flows into my pocket and nothing comes out. The renters cover my expense and I receive the income. Money for nothing. In my next example, again using the 300-unit apartment house, I will explain how I receive an infinite return by using leverage. The way this will be done is by raising rents and adding washers and dryers to each of the 300 units. The net $100 a month increase in rents is due to increased rents to match the competition, upgrades to the exterior, and fitting each unit with washers and dryers. This $100 a month increase in income is a 100% financed transaction. We get extra money from the bank to do the renovations. We have the control. The increase in debt is more than covered by our increase in income. This extra $100 is technically an infinite return because all the expense is fronted by the bank and all the returns come to me. The increase of $100 per month is multiplied by 300 units. This is an increase in gross income of $30,000 a month and $360,000 a year on top of the cash flow we are already getting. This $360,000 is an infinite return measured by cash flow in hand, not some fictitious capital gain on paper. In summary, the bank puts up 100% of the money for these improvements, and we receive the increase in income. The tenants pay for expenses and the mortgage. Number 3, IRR, or Internal Rate of Return. One of the more complex, sophisticated, and often confusing measures of ROI is the internal rate of return. If investors really know what they are doing, they can increase their ROI by understanding IRR. In overly simplified terms, internal rate of return, IRR, measures the other returns and other leverage that a well-controlled investment can provide. The first example of IRR is passive income. Most people understand that gross rents are part of the income column. Yet IRR also measures other forms of income. Passive income is subject to lower tax rates than earned income. In the U.S., passive income is not subject to Social Security or self-employment taxes. In other words, these taxes do not show up as expenses in the expense column, which is technically a gain in income. The second example of IRR is depreciation. In the U.S., the tax department gives some investors an additional income that actually looks like an expense. This income is known as depreciation. Another term for depreciation is phantom income. The reason it is phantom income is because it's income that shows up somewhere else. For example, let's say my tax bill is $1,000. The IRS may allow me to depreciate my investment by $200, allowing me to pay only $800 in taxes. This additional $200 is phantom income or money I did not have to pay. It is $200 that remains in my pocket instead of going to the government. Depreciation is allowed for such things as refrigerators, ceiling fans, carpet, furniture, and other items that decline in value with age. A tax accountant can explain this to you if you own a business or real estate. There is no such thing as depreciation for paper asset investors. A third example of internal rate of return is amortization, which is a fancy word for paying off debt on a scheduled basis. When you have good debt that someone else, such as a renter, pays for you, amortization becomes income to you. In other words, as a tenant pays down my debt, that payment is technically income to me. Income that is paid to reduce my debt as my cash stays in my pocket, ready for the next great investment opportunity to come my way. Additionally, while my tenant is paying down my debt, I still receive all the tax benefits associated with my investment. A fourth example of IRR is appreciation. Appreciation is the increase in asset value. This is also income to you. This is not appreciation based upon some appraiser's idea of an increase in sales price based on comparative sales in the area. The way I measure appreciation is by the actual increase in income to my income column. For example, the increase of $360,000 in income from my 300-unit apartment house is measurable. This is not an exact method for defining IRR, but it gives you an idea how an investor can increase his or her return on investment far higher than most investors can receive from paper assets. At least you have an idea of what an IRR is. I would guess 95% of investors have never heard of internal rates of return, so you are now smarter and sharper than 95% of the investors out there. The exit strategy. The beauty of the exit strategy on the 300-unit apartment house is once again the use of leverage to become even richer. Instead of selling the property and facing substantial capital gains taxes on the profit, we pull out the money by refinancing. We are able to do this because we have increased the value of the property through our improvements in management. The bank recognizes this increase in value and we are able to borrow against it. By leveraging the property's value, we pull money out of the property tax-free, and the improved operations more than cover the higher mortgage payment through higher income. By borrowing rather than selling, we get our down payment back tax-free, and we get to keep the asset. At this point, the property's income is an infinite return because we have no money invested in the deal, yet we receive the income. This is the ultimate leverage. Let's say after 5 years we are able to refinance the property and pull out $4 million tax-free. The $4 million refinanced dollars go to the investors and pay back all initial equity and then some. Even better, we still maintain control over the 300 units, and the increased mortgage payment of $280,000 is paid for by the $360,000 increase in income. The $360,000 increase in rental income minus $280,000 in increased interest expense leaves a net $80,000 in passive income. This $80,000 is an infinite return because the investors have received back their initial investment yet still receive cash flow. It is free money. The investors get $4 million back and move on to purchase another apartment house. This is an example of using control and leverage. This is an example of getting rich according to the rules of the new capitalism. Capitalism based on the use of debt to become richer. Rather than working hard to get out of debt, as those who follow the rules of old capitalism do, we work hard to find ways to get into more good debt and use more leverage. Starting with nothing. To some of you, a $17 million 300-unit apartment building sounds like a big investment. 10 years ago, buying a 300-unit apartment seemed big to Kim and me. 10 years from now, I am certain it will seem like a small investment. Kim, Ken, and I are already planning much bigger projects to take on. Donald Trump and I are looking at a massive project not far from my home, a project we will break ground on in 10 years. I mention the size and dollar amounts of projects to make 3 points. Number 1. Being born poor and financially uneducated does not mean you cannot become rich. Very few people are born rich enough to buy a $17 million apartment complex, and no one is born smart enough to acquire, finance, and manage a 300-unit apartment complex by themselves. In other words, not having any money or financial education isn't an excuse not to get started. Number 2. Start small and take baby steps. In 1989, Kim's first investment was a $45,000 two-bedroom, one-bath home in Portland, Oregon. She put $5,000 down and made $25 a month. She was extremely nervous when she took her first step. Today, a $17 million apartment house is boring to her. She is ready for bigger projects. Number 3. Dream big. Most of us know that a child must be allowed to dream. The same is true for adults. As a couple, Kim and I have big dreams. Our dreams keep our marriage rich, young, and fun. Bigger investment projects keep us learning together, operating as a team, and growing together rather than growing apart. Instead of living below our means, we dream big, learn, and invest carefully in order to go beyond our means. It's not just about money. It's about life. In conclusion, on August 9 and 10, 2007, as the markets of the world crashed, many people had no idea what the crash meant. Most people have no idea how it will affect their lives. Most people have no idea how the rule changes back in 1971 and 1974 have affected their lives. Today, even in the richest country in the world, the U.S., millions of educated, hard-working people are earning less, even if they are paid more, saving money that is losing value, clinging to their homes as their value declines, and using credit cards to pay their bills. To make matters worse, because of a market crash, millions of educated, hard-working people think that investing is risky, and to attain higher returns means you have to take on greater risks. There are only a few people who know that the key to leverage is control, and the key to control is financial intelligence. The good news is that the higher your financial intelligence, the more money you make without needing money. In this new capitalism, it is truly possible to make money for nothing. In the information age, knowledge is the ultimate leverage. The more money you make without money, the higher your ROI and IRR, and the higher your financial IQ.